Goldman Sachs' co-head of global FX and interest rates and emerging market strategy, Zach Pandl, joining us now. Zach, the Fed's current projections feel so far out of date. I'm wondering how significant an upgrade we are going to get this week, and then how the market is going to react to that, because Jan Hatzius' team obviously way ahead in terms of what they're expecting.
Well, this is exactly the issue, and I think you're right to emphasize the uncertainty. The Fed's projections at this point are quite stale. They're back from December, and a lot has happened since December. Most importantly, very large fiscal stimulus of the U.S. that has transformed the growth outlook here domestically, and to some extent, more and more information that the vaccination process is working around the world. So the Fed is going to need to make a major growth upgrade at this meeting. And the question is, to what extent does that feed through to the inflation outlook? And to what extent does it feed through the policy rate outlook? And I think really those two things are very uncertain at this point. We've gotten some communication from Fed officials in recent weeks, but it still leaves us guessing on exactly where the dot plot, the inflation forecasts are going to land. And that's going to determine quite a lot for how markets trade over the coming months. The shape of the yield curve, the direction of the dollar, probably are going to depend on what sort of message we get from the Fed on Wednesday.
Right. So, Zach, I guess break that down for us, because the market's so far ahead of the Fed that does the Fed mark to market their expectations with limited volatility? Or if they do that, do we see even a bigger re-rating of the long end?
Our research suggests that if the Fed is moving up the dots, the market's likely to move up as well, even though the market is already trading above where the Fed may end up. So if we get a one additional hike, two hikes in 2023 from the FOMC, we think that that will pass forward into front-end rates, even though the market is already trading above. So that would be a hawkish surprise and likely move the market. Where we go from there is going to depend on a lot of different aspects of the policy message. How long are they going to be doing quantitative easing? And is there any kind of guaranteed minimum timeline? I think that's going to be a key question. And exactly how much inflation do they want to see before they get going? If they show two hikes or one hike in 2023, but also a lot of inflation at that time, 2.2, 2.3% inflation, then that'll be easier for the market to digest. So it's really all three of these things: the QE timeline, number of rate hikes, how much inflation the Fed sees, that's going to determine the market reaction after Wednesday.
Zach, can I just back up a little bit? You mentioned talk there of the front end moving. And I think this is where life gets really interesting. Once we do start to get the front end of the curve starting to react significantly for the Fed, what do you think needs to happen to make that happen? How vigorous do you think the Fed is going to be in terms of its reaction to all of this? You mentioned that it will have some kind of an effect. I'm wondering how big an effect and what impact that will then subsequently have on the dollar.
Yeah, so anything beyond one additional rate hike in 2023 is probably going to start to move two-year note yields by a meaningful amount. And I would say I would feel even more strongly about that if the Fed gives us no kind of guaranteed timeline whatsoever on the balance sheet. We know the Fed is not going to be raising rates while it's still doing quantitative easing. So the timeline for running purchases at their current pace and then tapering them down helps us determine what can be priced at the front end of the curve. If we don't know that timeline, the market has to put in a risk premium that tapering and rate hikes happen much sooner than expected. And I think you're right to highlight that this is really where the dollar comes in. The dollar has been generally weak for some time because the front end of the curve hasn't really been moving. You've seen a bear steepening of the U.S. curve. That's not a big deal for the dollar. Dollar can generally weaken along those sides of moves. But once the front end starts moving, once we start to price in higher front-end yields that potentially raise the dollar's carry profile to other currencies, it's going to be harder for the dollar to remain weak. So we've had a structurally bearish dollar thesis. I would say we need to go open-minded into this Wednesday's meeting for potentially changing that view. If we get a substantially hawkish message from the Fed, the dollar could change direction for at least a few months here.